Thank you very much, Stephanie, for the very nice introduction, and also for Palladium inviting me to be here, and also for collaborating over the years to develop the inclusive growth framework and trying to make impact at scale and the impact economy a reality and not just a vision. So what I want to discuss with you this morning is some research that we have been doing over the past decade or so, showing how organizations can get to the stage of implementing inclusive growth strategies. And in doing that, I want to take a little bit of a step back. So when we talk about the impact economy, what does this mean? For me, what this means is moving to an economy that we have now, which is optimizing risk and return, and moving to an economy that is optimizing risk, return, and impact. And for that to be happening, the impact needs to be measurable and it needs to be intentional. And for us to be moving at impact at scale, it means that all organizations need to be doing that. It cannot be part of a niche market or of some organizations, but it needs to be something that is integrated in the business. And in doing that, I would say that we have gone through a journey over the past 30 to 40 years. And we started with this idea that basically the business of business is just business. And it's just about maximizing profits. And over time, with many institutional innovations, things are changing in business. And now we are moving to a perspective where people are understanding that the role of business is, of course, both to create profits and to cover its cost of capital and so forth, but at the same time, it is increasingly important that it creates impact. And in many ways, the more impact that it creates, the more successful the business ends up being. And many of those institutional innovations, I have put them here just to make it real about how in just 15 years, we went just from 20 companies reporting on their sustainability performance to more than 5,000 companies. How we went to establish new C-suite positions with chief sustainability officers and so forth, and how the capital markets also were mobilized to start taking impact into account. So this is a journey that we are in. And the critical question is, how can we actually have effective strategies? I know that throughout the whole day, you're going to be discussing about this ideation challenge, the financing challenge, and the governance challenge. But there is one more challenge even before that, which is how do organizations become ready to implement inclusive growth? How are they ready to start collaborating, being bold, collaborating, setting the governance systems, and so forth? And I want to show you some pieces of the puzzle that we have found over the past decade about how you overcome organizational inertia, in many cases resistance, and how do you create an organization that is ready for systems level thinking and tackling some of those inclusive growth challenges. And the way that I put it is with this graph, which is basically trying to say and trying to communicate that, first of all, in order to have an organization that is really optimizing risk, return, and impact, you need to have accountability structures throughout the organization. And those accountability structures and accountability mechanisms tend to be both top-down, coming from the governance angle, but also bottom-up, creating a purpose-driven organization, creating an organization where employees feel empowered both to have impact and meaning through their workplace. And that makes something incredible inside organizations, which is it makes the impact-driven attitude authentic. And as a result, employees buy into it. And once you have those two accountability mechanisms that operate as wheels that almost like click together, so you have the top-down from the governance angle and you have the bottom-down from creating a culture of purpose, then I want to discuss a little bit with you three of the elements. One is, what do we mean really about strategy in the impact space, and how this is different from operational effectiveness. And I will differentiate between common and unique practices. And this is extremely important because in the inclusive growth area, many of the strategies are actually differentiated strategies. You're trying to build a competitive advantage by doing that. The second one, I want to show you some insights around how do you build the organization from an operational perspective. in terms of organizational design and targets. And the third element is that to make it authentic and have the maximum impact that you can have, and as a result create the competitive advantage, you really need to align product and sales impact. And we need to start measuring product impact, and we need to start understanding not only operational impact, but also product impact. And for that, especially for organizations that have investor base, either in private markets or in public markets, what becomes extremely important is to continuously educate the investor base about the value that this impact approach is creating. And in the absence of that, I think many organizations see that at some point their investors are not supportive of what they're doing. And as a result, some of those efforts are getting in the backseat. So I will take you through each one of those elements and trying to give you some insights about what we have found and why all of those elements are important in order to get to the stage of being able to have systems-level thinking and implementing inclusive growth strategies. So let's start with the first one, governance. One of the first elements that we found in research that we did a little bit more than a decade ago, we tried to understand what differentiated organizations that put impact and sustainability efforts either through a social lens or an environmental lens, what differentiated them from their competitors. So we looked at organizations that were operating in the same industry, organizations that have about the same size, same profitability and everything, and we said, what differentiates those organizations? And we found three elements that operated at this level. And all of them, I call them governance-related elements, in the sense that the board of directors was operating in a different way, and those organizations had established very, very early on. That was in the mid-90s, a sustainability committee at the board level, and the board was responsible for the company's impact efforts. And also, executive compensation was linked to sustainability metrics and impact metrics. And that led to the second discovery, which is those organizations had just much better measurement systems. They were able to measure things that other organizations were not able to measure, as it came to employees, as it came to customers, as it came to suppliers, and the value that they were creating within their ecosystem. And the third element was that in their capital investment decisions, in their operating decisions, in their communications as well, they had a much longer horizon. So they were much more long-term oriented, which I think it's a necessary ingredient when you're thinking about inclusive growth and when you're trying to implement system change, which by its definition might take quite a long time compared to other types of strategies. So the governance structure, as it came to the functioning of the board and the incentives inside the organization, as it came to measurement and metrics, and as it came to the time horizon and the long-term orientation, were quite different. And the second discovery that we made, we looked at those companies and we followed them over time for about 20 years. And one of the things that we found was that the companies that had really adopted strategies and policies about many of those issues, they were able to outperform their competitors. So we tracked how much an investor would have gained by investing $1 in two portfolio of companies. With the gray line is what we call high sustainability companies. These are companies that had those elements that I showed you before, and the low sustainability companies were their competitors, operating in the same industry, same size, same profitability to start with, and we looked at the stock returns over time. And that is the accumulation of $1 invested back in 1992 and how much it has grown for those two portfolio of companies by end of 2010. And that created a lot of interest back then in terms of trying to understand why those organizations outcompete and what are the sources of value creation. So, and that led us to start understanding not only the top-down accountability mechanism, but also the bottom-up. What is the role of culture? Because one of the things that we heard repeatedly was that in many organizations, senior executives were developing strategies and they were making pronouncements and so forth. But when we're going inside organizations, we're finding a disconnect. we're finding that employees don't buy into what senior management is saying. And as a result, those strategies, in many ways, they were not being implemented effectively. So we try to understand a little bit about what's the role of purpose inside the organization. And for me, that goes a long way back to one of the most celebrated and most important economists of all time, John Maynard Keynes, when he famously said that there wouldn't be much investment of pretty much anything if it wasn't for motivations that human beings have that extend beyond profit. So of course we're motivated by profit, but there are many, many more things that motivate people inside the organizations. And if you want to bring the best out of people, you really need to tap into that level of motivation. So what we have done in this project is, over time, we have collected data on about 2 million employees across more than 1,000 organizations. And we have been able to operationalize purpose-driven organizations as those that employees hold strong beliefs both on the meaning and impact of their work. And this is, in our mind, an important finding in the following sense. Many organizations have those inclusive growth strategies or high-level impact strategies, but they have a really hard time connecting it to the day-to-day activities of the employees. As a result, employees feel that they are not engaged really, that they have no agency, that they have no impact on what the organization is doing. And as a result, we're able to find that organizations that are able to bridge that gap are creating a purpose-driven culture where people feel that those efforts are authentic and themselves are going the extra step of driving those efforts. And one of the findings was that as you go through the hierarchy of the organization and you go from senior management to middle management and even further down to lower level employees, that sense of purpose in general declines. And this is where we found that the strategy execution of many of those impact strategies is lacking, because actually middle management is not buying into them. And as a result, they are not implementing. Middle management is perhaps, you can say, where strategy development becomes strategy execution, where the rubber meets the road. And if you cannot get that layer of the organization to buy functionally, but also in the different geographic locations, then it becomes a very, very hard thing. And what we were able to document as well was that to the extent that you were able to convince and have that strong sense of purpose and culture inside the organization that diffuses throughout the organization and inside the middle management as well, we're finding that those organizations were able to outperform their competition. And they were able to operationalize and execute on those impact strategies. So one overall key conclusion from that line of research has been that strategy development and pronouncements are not enough. You need to establish the right accountability mechanism inside the organization for those strategies to be executed. And those come both from the top and how actually the board is engaged and the management is incentivized, but also importantly, it needs to come from the bottom and the type of culture that you create in an organization and whether you engage people in this impact journey. And once you have those accountability structures, then we started trying to understand a little bit about strategy. And I want to show you some evidence about what we have found as more and more organizations are celebrating their sustainability strategies. And one of the first things that we found was that many organizations actually, they don't necessarily concentrate on what is financially material for their own industry. And if you go actually across industries, you will find that there is a small number of issues that are very, very important and as a result can drive the business and can drive a lot of impact as well. So if you go, for example, to the electric utility sector and the energy sector, you find that carbon emissions and climate change is a very, very important issue. If you go to the technology sector, privacy issues and so forth. If you go to the consumer goods sector, supply chain issues and issues of environmental degradation, and of course, inequality and poverty are very, very issues and so forth. So one of the things that we did in this line of research, we took a step back and we said, well, out of all the different types of issues that you can imagine in the impact space, what is financially material for each one of the industries? And we systematically analyzed that, and we found that out of all the metrics that companies are reporting for any given industry, only about 15 to 20% of those metrics were on issues that were industry-specific financially material. And one of the findings was that as we were going and doing that, industry by industry, and of course, as you can imagine, these metrics were different metrics for each industry, so they need to be customized. One of the things that we found was that the companies that were actually outperforming their competitors on the material sustainability issues, they were the ones that were driving performance. And I'm showing you here on a sample of about 2,500 companies that have, with the red, strong performance on sustainability issues versus weak performance on the sustainability issues. Again, those are comparisons across competitors that otherwise look similar, and this is over 21 years. And what you can see here is, again, the evolution of $1 invested in the early 1990s. And equally, I would say, interestingly, what you find on the right-hand side is that the companies that were investing resources on industry-specific issues that are not important for that industry were actually underperforming their competition. And that started getting us to think systematically about what is that you're competing on, what can you have performance, and how can you concentrate your efforts through that value creation process. And one of the things that we found in this journey was that also what most organizations call as strategies, they're not really strategies. And the reason for that is because strategy, as our colleague Mike Porter famously said, strategy is about a unique competitive positioning. So it's about your differentiated position in the competitive marketplace. And one of the things that we found with many of those sustainability strategies was that they were not unique. We found that over time, there is a lot of convergence that is happening within an industry. So there is a lot of imitation and a lot of convergence. And as a result, companies are not developing a competitive advantage. They are trying to a little bit kind of like imitate what other people are doing, and in many cases, they are driving surely operational effectiveness, but they are not building long-lasting relationships, and they are not changing the system in a way that provides for them a competitive advantage. And this is what I'm showing you here in this graph, which is from real data, where we observed in 2012, and if you were taking some of those strategies, you were finding that they were very dispersed. And by 2017, the same set of companies had converged, basically, and they were pretty much doing all the same things. And a little bit more data about what was happening. We found that the industries that converged quite a bit, for example, was companies in the biotechnology sector, auto components, household durables, and airlines, and so forth. And what were the common elements that those industries had? A couple of them. We found that in general, when market leaders have more developed strategies, there is more imitation going on in that industry. We also found that when companies are reactive instead of proactive to stakeholder demands, then there is more imitation and more convergence going on in the industry. And that was an important message for us as well. Why? Because we realized that strategy is about being proactive, and especially thinking about inclusive growth strategy and trying to be bold and solve some of those financing governance challenges This doesn't tend to happen because you have stakeholder pressure, and after that, you're trying to do that. It's because actually this is part of you're making that part of the DNA and the culture of the organization, and you're trying to drive performance. And that proactive message was an increasingly important one, and this was one of the things that we found in the data. On the other side, you can see some of the industries that have shown very little convergence over time, such as, for example, automobiles on integrated oil and gas. These are industries where you find companies doing quite different things, or in some cases not have developed strategies at all. One of the things that was important when we looked at some of those patterns was trying to understand how the competitive advantage is then flowing into developing return on capital and affecting your return on capital. And again, one of the things that was interesting and that we found was that there was a very different effect when you're looking at the financials of a company based on whether a company is developing a differentiated positioning versus imitating its competitors. And one of the things that we found was that in our sample, this is a sample of about 3,800 global companies that we studied in this paper, and we found that on average they had a return on capital of 8.3%. And we found that the companies that were able to develop a differentiated inclusive growth strategy, over time, after 6 years, they were able to raise their return on capital to about 9.4%. And this is an indication, we used it as an indication that it really links to competitive advantage, because the only way to raise your return on capital in a sustainable way is through a competitive advantage. And we found that the ones that actually remain laggards on what are becoming common practices in the industry, they fell behind in terms of that return on capital, because they were falling out of the supply chains as their customers were asking for more and so forth, and they were losing business, they were becoming ineffective and so forth. So we need to think about strategy both as unique versus common practices. And something that is important is that when speaking about inclusive growth, these are unique practices. We're talking about some practices and changing your ecosystem in a way that is not easy to imitate, and as a result, it's building a competitive advantage. And the common practices and a lot of the imitation that is happening in the marketplace is actually almost table stakes, standards for not falling behind on your industry. And this is exactly what we found. And the other thing that was very, very interesting to us was that firms that were able to really make progress and grow from laggards to leaders, they really also show benefits in terms of their valuation. And they were actually able to be some of the best performing companies within their industries, looking at the data. So the way that we operationalized that was that we basically said, not everybody needs to start from a very high place. Actually, there is always room to improve, and this is a journey that every single company can go and have actually incremental improvement and start implementing some of those strategies. So after looking at the strategies, we started looking at some examples of what it takes to have an operational design that drive those strategies. And one of the things that we were able to document was that most of those companies are going through a maturity stage, a three-stage process of maturing. The first one, and how most companies start, is through a compliance approach, which is basically saying, let's make sure that we comply with all laws and regulations or expectations. Let's make sure that we do nothing that is going to cause a scandal and is going to create chaos inside the organization. And over time, as those efforts are maturing, organizations are moving towards an operational efficiency stage, where they are trying to drive mostly cost savings and improvements. And you find that especially in the environmental space, they're reducing waste, they're reducing energy, and so forth. But of course, that is not driving the top line. That can drive, of course, the bottom line and your cost structure. And we were increasingly interested in understanding what's happening in the third stage, which is what we call growth and innovation. And this is the stage where inclusive growth strategies are happening as well. And organizations need to move that way. I would say most organizations are still stuck in the operational effectiveness stage. And they are having trouble for many of the reasons that you're going to be discussing today on moving to that third stage. And this is why that discussion is extremely important, because if you don't solve the ideation, financing, and governance challenge, one of the things that we have found is that you get stuck in the second stage. And many organizations now have perfected that second stage, and they're really driving operational effectiveness and cost synergies, but they are having a hard time moving to a systems level thinking that drives new products, new markets, and new ecosystems that create tremendous impact. And in terms of the organizational design, we found some really interesting results as we looked at those organizations and how they were going through the stages. And you can see at the bottom axis there, at the horizontal axis, that I have the stages there: compliance, efficiency, and growth and innovation. And what we found was that as the person responsible for those efforts, and in different organizations they have different names, as I'm sure in your organizations have as well, in terms of head of impact or chief sustainability officer and so forth, we found that the authority of that position in terms of decision making and decision rights was increasing as you were going from compliance to efficiency and to growth and innovation. So as you were going to growth and innovation, that person was much more likely to be reporting directly to the CEO or directly to the board, have executive level incentives and so forth. That was not very surprising. What was more surprising was this inverse U-shaped relationship between the stages and the centralization of the activities. So one of the things that we found was that as organizations are moving from the compliance to the efficiency stage, many of the centralization of decision rights was increasing to those positions. So as a chief sustainability officer, you were actually centralizing many of those decision rights in terms of making operational decisions or product-related decisions and so forth, to be able to drive some of those efficiency gains. But what we found in the growth and innovation stage is exactly the opposite, that then those activities were being decentralized to the different functions. Because if you don't decentralize to the different functions, then it becomes very, very hard to engage people and start the innovation process that is flowing into new markets, new products, and new activities through the organization. And we found that getting the functions to buy in the inclusive growth strategies is an extremely, extremely important perspective. So drawing in people from finance and from marketing and from communications and from the capital budgeting process and from the product development process and the procurement process and so forth requires that you make all these people accountable in the organization for the execution of those strategies. And this is exactly what we found in this third stage. And the other thing that we found, we tried to understand how you can actually drive successful performance on many of those activities. And one of the things that we were able to document, and that links to the idea of being bold and leading to the ideation process, we found that there was a positive relationship between target difficulty and target completion in this space. So we studied thousands of targets that organizations set in this space, and we were able to document this positive relationship. And we found that was especially true if those targets were not accompanied by monetary incentives. So we found that actually, to the extent that they were accompanied by monetary incentives, the difficulty of the target and the target completion had a flatter relationship, not as positive. And I think that goes back to a lot of research that has happened in the psychology space about how people actually get motivated to improve performance. And we found that being bold, setting more ambitious targets in a counterintuitive way actually makes it more likely that you will complete the targets. Because you could say that less difficult targets are easier and as a result, you should be able to complete them. No, we found actually the exact opposite, that it was more the bold thinking that was mobilizing the organization and getting everybody to take that extra step and get extra committed and drive performance inside the organization. I want to move to the second to last component here, which is one of the things that became also apparent as we have talked about governance, as we have talked about purpose and culture, as we have talked about strategy, and of course operations as well, is what happens if actually, let's say you do all these things, but fundamentally the product that you're selling is a harmful product, right? And that disconnect exists in many organizations, and I think many organizations are still struggling with this. So what if fundamentally you're selling tobacco, or you're selling coal, or you're selling just sugar drinks? And I like them sometimes, I enjoy them, but not a lot. And as a result, I think increasingly what is becoming really, really important is moving incrementally on understanding product impact and how one can improve in a positive way product impact and align that with everything that we have been discussing. So moving to a direction where the sales and the revenues and the inclusive growth commitments are mutual goals instead of being separate goals, where you can say, well, I'm doing all these things, and we have the strategies here at the operation perspective, but the product is a completely different story. And I think that's where many of the efforts actually break down, because organizations see them as silos. They see their product as one thing that you cannot touch it, and then they say, take care of the operations and improve a little bit the impact from the operations. And at some point, this creates tension inside the organization, because you're trying to create positive impact here, but that doesn't translate into the product. And I think we see many innovations actually happening in the product impact space. I think Philips is an example of that, looking at lighting as a service, new business models, where as we have had now software as a service, looking at lighting as a service where customers pay for light used, and Philips maintains ownership of the equipment and moving towards a circular economy. This is a great example of how one can move towards understanding much better product impact. And of course, then being able to measure some of those things, right, in terms of what percentage of your revenues actually satisfies your strategy. In this case, 77%. How much electricity is coming from renewables, industrial waste recycled, and how much of that is carbon neutral. And industrials is not only the only space that one could systematically start understanding product impact, and as a result making different business model choices and strategy choices on that product impact. Another example that I will show you here, and it becomes important in terms of building investor relationships, is also in terms of Novartis, for example. So they have been over time measuring the employment impact that they create, the environmental impact, but also product impact, trying to assess the innovative medicines portfolio across 29 countries and the type of impact that the product creates for patients at the end of the day. And what I want you to take from here is the difference in the magnitude of that impact across the three categories. And I really want us to take a step back and reflect a little bit of that, because inclusive growth is about the product as well, to a large extent. And of course, you can create tremendous impact through your employment, $7 billion in this case, and of course, environmental impact, $4.7 billion. But the product impact at the end of the day creates $72 billion of impact. And I think we're at the early stages of trying to create more robust and sophisticated impact valuation methodologies, and as a result, having impact-weighted accounting numbers that can guide our thinking in this space. And as we're moving towards that, something extremely important that is happening on the investor relationship building space as well is over time moving from commitments and efforts and inputs towards outcomes and impacts, and starting to measure outcomes and impacts. And this is something extremely important that needs to happen in order to build investor support for all these efforts. At the end of the day, it's so far that you can go by saying here are commitments, and they can be bold commitments, but at the end of the day, what are the outcomes that those efforts are being generating? And I think moving towards a space where we can actually measure some of those impacts is an extremely important space. And I just want to make that real here and try to show you a little bit of how that plays just in human capital development space. So you can take a simple example as what is the dollars. Many organizations now will report and will make a big deal out of dollars spent in training their employees and create them for the future of work and for the technological progress and so forth. And I always say that, great, but what does it do for these people? That is the critical question. What are you training them on, and are they end up getting more wages over time, for example, or getting promotions and so forth? So in some recent work, we have been trying to differentiate between those two things, and being able to measure growth in wage per dollar spent in training across thousands of organizations. And we have been able to document that although there is absolutely no relationship between training dollars spent in employees and productivity of employees, there is a very strong relationship, as I'm showing you here, between a metric that looks at growth in wages per dollar spent in training and the productivity of the employees. So moving from inputs towards outcomes and understanding the effectiveness with which we use our efforts to create those outcomes can potentially be a very, very effective mechanism of moving those strategies forward. So I just want to close. I know we're towards the end of our time. Again, with this graph and setting up the discussion for developing the inclusive growth strategies of how can you make an organization that is really authentic about its inclusive growth strategies, and as a result get buy-in from employees, from investors, and from all partners that need to be part of the ecosystem. And I think both building for the organization the accountability systems from a top-down approach and from a bottom-up approach makes those efforts credible, and then driving that by differentiating strategies to common and unique practices, by understanding when you need to decentralize decision rights inside an organization and how do you set targets to drive performance, and of course understanding alignment with product impact and how you can increase product impact, and then communicating all these efforts in an effective way so you get investor support is something that we have found it's a necessary condition for moving to a systems level thinking and changing ecosystems and creating tremendous positive impact and unlocking that positive impact. And I think if we cannot do that and move to that third stage, impact at scale at the end of the day will remain a dream and not a reality. To move to impact at scale, we need to make all organizations having inclusive growth strategies. Only then it will be that both sides of the capital market, both investors and companies, will be optimizing for risk, return, and impact. Thank you very much.